All right, let's get right into it. The biggest, smartest investors out there, well, they're feeling incredibly confident right now. We're talking about a level of optimism, of extreme bullishness that we haven't seen in years. It's definitely turning some heads.
And that, of course, raises a massive question. It's really the heart of what we're going to unpack here. Is all this confidence a golden opportunity, a sign to jump in with both feet? Or is it a huge, flashing red warning sign that things are about to get a little too hot?
And look, the proof of this confidence is right there in the numbers. The biggest fund managers are holding the least amount of cash they've had in more than 3 years. So what does that tell you? It means they've taken their money off the sidelines and put it right back into the stock market. That's a huge vote of confidence that they believe stocks are going to keep climbing.
So you got to ask, why? What's got these seasoned pros so optimistic? Let's get inside their heads for a minute and break down the case for optimism.
When you really boil it all down, their confidence seems to rest on 3 key pillars. Number 1, the AI revolution. Number 2, what they expect to happen with interest rates. And number 3, good old-fashioned corporate profits. Let's dig into each one.
So first up, and this one's impossible to ignore, is artificial intelligence. And this isn't just hype anymore. AI companies are actually driving massive earnings growth. We're seeing big tech companies post these incredible profits, and the general feeling among investors is that, wow, this AI boom is really truly just getting started.
Okay, driver number 2 is all about interest rates. There's this widespread belief, this expectation that the Federal Reserve is about to start cutting rates. And why does that matter? Well, historically, lower rates mean it's cheaper for companies to borrow money and grow their business. That activity can really fire up the economy and, you guessed it, push stock prices higher. And that brings us to the third pillar holding this all up. Corporate profits are just really strong. Despite everything you hear about inflation or a shaky economy, major U.S. companies just keep reporting solid, healthy earnings. For a big-time investor, that's a pretty clear signal that maybe, just maybe, the worst is behind us.
So that's the argument for being optimistic, and I gotta say, it sounds pretty convincing. But if we're gonna be smart about this, we have to flip the coin over and look at the other side. So let's talk about the hidden dangers that might be lurking just beneath the surface.
The first big risk is something called market concentration. Basically, what this means is that all this excitement, all this bullishness, it isn't really spread out across the whole market. Nope, it's focused really intensely on just a tiny handful of companies. Think about it like this. In a healthy, diversified market, if one part of it has a bad day, it doesn't sink the whole ship, right? But with the kind of concentrated market we have now, if just a few of those giant tech stocks take a tumble, they can drag the entire market down with them. It is the classic mistake of putting all your eggs in one basket. The second risk actually takes us right back to AI, but it asks a tougher question. Are we in a situation of hype versus reality? Is it possible the excitement has just gotten way, way ahead of the actual results?
This worry is leading some analysts to warn that we could be entering what's known as an AI bubble. And as you see here, that's when stock prices for these companies get pumped up way beyond what they're fundamentally worth, all driven by speculative hype instead of real, tangible value. And well, we've definitely seen this movie before.
And that brings us to our third and final risk. It actually loops right back to the very beginning, to those low cash levels. The danger here is that with so much money already in the market, there's just no safety net.
So why is that such a big deal? Well, because when every investor has already bet all their chips, there's very little cash left on the sidelines to act as a cushion. If the market suddenly takes a nosedive, who's left to buy? There are fewer people ready to jump in and stop the bleeding, and that could make any downturn much faster and much more painful. Look, this is not a new idea. It's actually a pretty powerful lesson from market history. This quote really nails it. When everyone is extremely bullish, markets become fragile. It's that classic fear of heights. When everyone is on the same side of the trade, there's nobody left to push prices higher. The whole thing becomes delicate. Okay, so we've seen the powerful case for why everyone's so optimistic. And we've laid out some pretty serious hidden dangers. So what in the world does this all mean for you as an investor? Let's get practical. Let's open up your investor playbook. All right, here's a simple checklist for navigating this. First off, don't panic, but also don't just blindly chase the hype. Be smart. Second, diversify your investments. That is the #1 defense against concentration risk. Third,
Try to avoid putting all your money into that one hot area, no matter how tempting it feels. And finally, keep some cash ready. Having that dry powder gives you the power to jump on opportunities when everyone else is scared.
When you get right down to it, getting through this kind of market is all about one simple, powerful idea. The key is to balance all that optimism that's out there with a healthy dose of your own caution. You have to see the potential for big gains, but never lose respect for the potential risks.
And that leaves us with one last thought to chew on. The smart money. They've clearly placed their bet. They're all in. Now that you know both the incredible opportunities and the serious risks, the real question is, how will you place yours?